at National Bank Financial featuring Evolve ETFs. My name is Sienna Foynacy and I'm an associate with Dollar Wealth Management. At Dollar Wealth Management, we strive to inspire, create, and develop positive change by optimizing your wealth with investment and portfolio management strategies that are tax efficient and built with you in mind. Our agenda today will respect your time as we aim to keep this presentation short and to the point to maximize its value. I would like to introduce the head of Dollar Wealth Management, Romel Dalla. Romel is a portfolio manager with 15 years of experience who combines his investment expertise with the team's in-depth financial and estate planning. Romel will now introduce the principles of Evolve, who will then discuss opportunities, market outlook, and then answer a few questions at the end. I'd like to now hand it over to Romel to tell you more about Evolve.
Thanks, Sienna, and once again, thanks for listening in to our virtual seminar. I think I'm at 16 years at this now, so I just had my work anniversary a few weeks ago, so happy anniversary to me. But more importantly, I'd like to thank Elliot from Evolve ETFs for joining us today from Toronto. Evolve's recent launch of their Edge ETF presents an interesting opportunity with respect to tech investing, presenting investors exposure to the tech sector in a passive manner that removes much of the guesswork out of investing into individual companies. As the tech sector continues to grow, especially during this pandemic, the ETF provides broad coverage that may be a suitable component for some portfolios, and I'm very excited to talk to Elliot today about exactly how this ETF works. I'd now like to introduce our speaker formally. Mr. Elliot Johnson is Chief Investment Officer and Chief Operating Officer with Evolve ETFs. Prior to joining Evolve ETFs, Mr. Johnson was Senior Vice President, Retail Markets at Fiera Capital Corporation, a prominent Canadian investment management firm. Prior to this role, Mr. Johnson served as Chief Operating Officer of Fiera Quantum Limited Partnership, an alternative investment manager. From 2010 to 2012, Mr. Johnson led technology management efforts for a number of businesses at National Bank of Canada. Prior to 2012, he spent 13 years at GMP Capital Corporation in a variety of management roles across institutional brokerage, wealth management, and asset management businesses. Mr. Johnson holds the Canadian Investment Manager designation, the Derivatives Market Specialist designation, and is a fellow of the Canadian Securities Institute. From 2016 to 2020, he served on the board of Trinity College at the University of Toronto as chair of the Committee on Investments. Mr. Johnson currently serves as chair, president, and trustee of Upper Canada College Foundation and is also trustee of the US-based Upper Canada Educational Foundation. With that, I'd like to ask Elliot to begin his presentation.
Thanks, Romel, and thank you for that warm welcome. It's great to speak with you today, and I really appreciate everybody who's tuning into this webinar to talk a little bit about disruptive tech. It's an area of the market that we have been excited about since we launched our business. And I think it's even more relevant today and is more relevant each day that passes. So I'm going to share my presentation here. And here we go. This is a snapshot of Evolve. Just a quick background on Evolve before I jump into the Evolve Innovation Index ETF that is the subject of the presentation today. Evolve's been around in the market for 3.5 years. We launched our business back in the fall of 2017. We believe that the asset management industry needs more tools to help investors invest in themes that are relevant over the future years ahead rather than looking back at what was relevant in the past. And we've really made a name for ourselves in Canada as a leader in disruptive innovation. We launched Canada's first cybersecurity ETF back in September of 2017. At the same time, we also launched the first ETF, or first fund, in fact, in the world to track innovation in the auto sector, dealing with the supply chain that has companies that make electric cars, batteries for electric cars, self-driving innovations. We'll get into that actually a little bit in this presentation because some of these disruptive tech products are a part of the innovation index ETF that we'll be talking about. But needless to say, disruptive innovation has been our flagship product line since we launched our business. But it's not our entire business, it's about a third of it. We also have a number of equity income strategies where we track indexes that cover mainstream asset classes. Life covers healthcare stocks, base is materials and mining, call is US banks. And on top of those indices, we write options to increase dividend for investors. On the active side, we partner with some of the best-in-class active managers in the world. Allianz Global Investors, for example, runs a global bond fund for us called EARN, and Addenda Capital out of Montreal runs Canadian preferred shares in DIVs and Canadian credit in fixed. And we also have a cash ETF as well. So our product line has grown very nicely. We've been very pleased with the growth of our business, getting to over $1.8 billion in 3.5 years. This makes us one of the fastest growing asset managers in Canada. We are completely independent as well. And so all of our growth has come from the support of individual investors and advisors like you who have found that our products resonate with them in how they're looking at their portfolios and the ways that they're thinking about investing in the years ahead. So thematic ETFs is really what we're talking about here. And as I mentioned, Edge is our broadest base, most diversified thematic ETF. But just on this slide to very quickly talk about why thematic ETFs are relevant. And it really has to do with the way in which you can increase diversification and growth within your portfolio. So one of the things that we often talk about with investors is just how much tech you have in passive investing in things like the S&P 500 and the NASDAQ 100. The big tech stocks, Facebook, Amazon, Apple, Google, those stocks represent about 25% of the S&P 500 and about 46% of the NASDAQ 100. And these are massive companies, you know, $1 to $2 trillion in market cap. So what that really means for investors is that if you passively invest, you're overweight tech, but underweight growth because you have your concentration in just those large companies. You don't really have diversification across the tech themes that you think you have. So if you think about tech as a category and you take yourself back 20 years and say, well, what am I hiring tech for in my portfolio? The answer really is it's for growth. It's your growth driver. It's the thing that's supposed to keep your portfolio relevant as the world enhances and evolves in the future due to these breakthroughs in technology. So we built our theme-based disruptive tech ETFs to help investors put that growth back into their portfolios. And so there's nothing wrong with having a core portfolio that has the S&P 500 in it. For example, you need your beta drivers. They're important building blocks of any portfolio strategy. But now with our thematic ETFs, there are the tools to allow investors to inject that growth back into their tech allocation within their portfolios. And as you can see from the numbers on the chart here, there's very little overlap between these strategies and those broader indices. And the growth in flows into the thematic sector, the chart on the right shows this in the US last year, has really accelerated as investors have started to look at these themes. And I think there's been a shift in thinking that says these are not niche themes. There's nothing niche about cloud computing. There's nothing niche about cybersecurity. This is mainstream. Everybody's using these services. I think it really took the pandemic for people to realize just how important these digital services are to their lives. And that's caused investors to jump on top of these themes even more so than they were before. So let's talk a little bit about disruptive tech and put some numbers around it. One of the stats that really opened our eyes to this was from a McKinsey report that says that over the next 10 years, an estimated $90 trillion will be added to the equity markets, and more than half of that is expected to come from disruptive tech. So if you let that sink in for a second, it really points out that the single biggest category of growth for the equity markets is expected to come from disruptive technologies. Or maybe to say the same thing in a slightly different way, if you fast forward 10 years from now, the things that have driven growth in your portfolio over that 10-year period are going to be a result of technologies that may not be in your lives today, maybe are starting to be in your lives today, but get adopted over the course of that period of time. And just to point out perhaps one metric on this that always makes me realize just how fast things change. Facebook went public less than 10 years ago. So when you think about that, that's a company now that is on everybody's lips, and you don't even require any explanation or introduction to what Facebook is. But it's less than 10 years old as a public company. So if you went back 10 years ago, people weren't even investing in it on a public basis because it was so new. And innovation is speeding up. These kinds of effects are increasing in speed. And that's why we put this fund together. So let's talk a little bit about the fund and what we did and why we put it together. So at the core of our thinking around disruptive technology is data. Data is the new oil. That's not a phrase that we came up with, but it's a saying that we believe best captures the value of data in society today. It is the energy input to innovation. Everything is starting from a data first perspective. Now that happens a lot in the cloud, and so cloud computing and data centers is at the core of our product. If you think about what happens with your phone when you turn it onto airplane mode, it becomes a whole lot less interesting and useful. It can't tell you how to get to a place you're going by showing you a map. It doesn't have any information about your friends, your email, any of your social apps. It won't tell you anything about what's happening in your meetings and calendar. The cloud is where your data and everybody's data is stored, and it's where really intelligent things happen. You know, if I put in to my Google, how do I drive to Romel's office, it's going to tell me, here are the roads to take, here's how to avoid congestion and so on, because it has all that information in the cloud. So the cloud is where the data lives, and it's where that analytics is happening, and combining that cloud computing with smarter devices like your phone, which, you know, has got to be a huge amount more capable today than your phone was 5 years ago, let alone 10 years ago. You can see how fast the virtuous cycle of innovation accelerates. So data is at the core of our product, and data is at the core of all of our thinking around innovation. But data by itself is not worth anything. So you have to wrap the data with some critical infrastructure. The first thing is cybersecurity. If you don't have cybersecurity protecting your data, you're going to have hackers, you're going to have breaches, you're going to have problems. And so the cybersecurity industry has been at the core of our investment thinking since we launched Evolve back in 2017. This is one of those areas of the market where you have negative unemployment due to the incredible growth that's happening in cybersecurity, because everything is becoming a connected device. The Internet of Things is driving this move towards more cybersecurity, as is the move into cloud services. You know, the cybersecurity industry saw a massive uptick last year with the work from home, sudden work from home move that happened as a result of the pandemic. That's because a lot of cybersecurity services in an office setting are all about assuming that the attack will come from outside the office. And so offices might have a firewall, and then inside their firewall, they have their employees' computers, and they just did their security at that firewall level with a little bit of antivirus software. But suddenly everybody went home. And so companies all had to immediately pivot to what's called a trustless model of cybersecurity, where my devices are my Wi-Fi network, or maybe on my Starbucks Wi-Fi if I go to a coffee shop to work from there, or wherever I happen to be. And that's true for all the employees in my business. And so we don't have one place where all of our data is that we can protect with some firewalls. Everybody's machine has to have full corporate grade cybersecurity tools on it. And so that has caused an enormous amount of additional spend in the cybersecurity industry as companies were hired to retool people's cybersecurity profiles to meet the new work from home environment, which will continue on for sure as time goes by. So you've got your data, you've protected your data, you need to get to your data, and that's where 5G comes in. 5G networking is a critical part of this product because the ability for us to do more interesting things really has a large reliance on how quickly can we get from our smart devices, our phones, our cars, or anything else to that data that's held in the cloud. And 5G is revolutionizing that. This is an order of magnitude improvement over the 4G networking that you have today. So far, you kind of see speed tests and sort of bake-offs between people who are running a movie download on a 5G versus a 4G network, and it comes down, you know, a high definition movie comes down in a second or two. But the truth of the matter is the real applications of 5G probably haven't been invented yet. You're talking about the bandwidth to support the entire economy moving to much smarter vehicles, just to pick one example from automotive innovation. As vehicles and road infrastructure all have the ability to connect over a 5G network, the throughput of all of that data can go up to cloud services, which can help cars be safer on the road. And that's just one example of many. So 5G is a critical part of the infrastructure that is happening now. And from an economic perspective, the exciting thing about 5G is that the additional bandwidth comes from a smaller wavelength of the 5G radio versus a 4G radio. It's called millimeter wave spectrum. And the knock-on effect of that technical change is that for every 4G radio tower that's out there to support our phones today, they're going to have to put up 4 towers for every 1 current tower because you need more infrastructure in place to support the throughput. That's an amazing thing for the people who make the chips that go into those towers. It's an amazing thing for all the people that are working on that 5G revolution. And the carriers have to do it because now you can buy phones that have 5G and nobody can be left behind. So the 5G revolution is real, and it's causing a huge amount of infrastructure spend that's transforming what we can do with data as we move around the world. So those 3 categories, cloud computing, cybersecurity, and 5G, are what we think of as infrastructure within the Innovation Index Fund. But infrastructure is only useful if you're doing something with it. And as a result of that, we picked the 5 categories of the economy that we thought were being most disrupted by data science and the innovations that come out of a data-first approach. And so just going around the ring here, automotive innovation has been at the focus of our investment practice since we started the business. Back in 2017, we were trying to think about what products really would be most meaningful to investors over the next 10 to 20 years. And this was one of our first ideas because it just seems so obvious as a trend that's happening out there in the world. Every car company today has got electric drivetrain products coming down their pipeline as they try to hit some of the goals that are being set by companies and countries that are demanding cleaner cars on the road. Norway, for example, has set 2025 as the final year that they will permit gasoline or diesel cars to be sold in that country. And we've seen similar dates of 2030 to 2040 being set by the UK, Europe, China, India, the state of California in recent months also set dates like that. So your car 5 years from now is going to have some component of electrification to it, whether it's hybrid or continues to be somewhat gasoline along with other electric drivetrains like hybrid drivetrains, or whether it goes all the way over to becoming a fully electric vehicle. Now, not just the power source is changing in a car, and in fact, obviously the cars are getting smarter. I got a new car at the end of last year, and it's like driving a computer. This car can back itself up based on my driving inputs when I drove into my parking spot. It can parallel park by itself. It gives me all sorts of driver assist, lane change warning indicators, blind spot warning indicators, backup indicators, obviously backup cameras, and so on. A lot of these innovations are coming as a result of legislation. You can't buy a car without a backup camera these days because it's just so much safer to back up and see where you're going. But they are coming in bits and pieces. And so what you're seeing is, as lives are saved based on these innovations, governments say, well, that just now has to be in every car. And then it also becomes a competitive advantage for car companies to make their cars safer products. So all of these innovations in making the car smarter are based on data and chips. And the kinds of companies making those chips, for example, NVIDIA, known for video game chips, is also revolutionizing the car. So the car is becoming a smart electric device, essentially like a cell phone that happens to have seats and wheels, and is continuing to take over jobs from the driver and be cleaner for the environment. We couldn't be more excited about that category. Similar to automotive innovation, if we drop to the bottom of this diagram, is robotics and automation. It's about smart machines, but it's in different contexts. And so smart robots are taking over the world in terms of what they're allowing companies and individuals to do. So in the portfolio, we have, for example, a robotics company called Fanuc. I'll show you on this slide some of the holdings here. Fanuc is in the robotics section in the middle here with the yellow logo with the red writing. That's your traditional robot in a factory. It's a single arm that can weld things together, but they're way smarter than they used to be because it has cameras on it. It has chips from companies like NVIDIA and AMD that allow it to see what it's doing. It's no longer a one-trick pony in terms of what it can do. It can do many more things, which allows manufacturing to be way more flexible. It allows companies to really speed up what they can do in terms of manufacturing. Another favorite within this category is Intuitive Surgical. These folks make surgery robots called the Da Vinci line of robots. I have a very good friend of mine who is a surgeon in the US, and he does surgery procedures on infants, which is obviously a pretty technical job because of how small they are. And he uses Intuitive Surgical robots and has told me many times that those robots allow him to do things that he really couldn't do before he had that technology because they're so precise and they allow the surgeon to enhance their abilities and have far fewer complications and far fewer problems because the robot is able to do things so precisely. It's a real revolution in surgical care that's coming out of this kind of innovation. And that's the kind of thing that makes us super excited because it's the enhancement of human potential that we think is the role of technology in society, and we're definitely seeing it there. Moving on to another healthcare related category, genomics is a category in this product and probably requires very little introduction at the moment, given what's happened this year with the pandemic. We've seen how genomics unlocked the ability for drug companies to create a vaccine very quickly, really in record time. And the economic case for genomics is that effectively drug companies are switching over to a genome first approach to drug therapy because it allows them to be far more targeted in their research and development. It used to be they started with a chemistry first approach. They would say, well, we can mix a bunch of stuff together. We hope we get it right. And then we move into trials and testing. And then we kind of go back and refine it. But that's a bit like trying to hit the bullseye on a dartboard with a blindfold on. You don't really know which way you're throwing to begin with. You just get kind of corrective inputs along the way. But with the genome, the human genome is the biggest big data project that's ever been undertaken by mankind. It allows companies to go right into where they need to. And so with the coronavirus, the sequence of that virus was discovered very quickly. Once they discovered COVID, they sequenced the virus. They know what it looks like. That's how they can tell one variant from another. They can then dial in the vaccines and get those vaccines into people's arms. And the fact that we started to vaccinate people within a year of discovering the coronavirus is such a testament to what's happened in genomics. There is no way that could have happened if the COVID outbreak had happened 5 years ago, let alone further back than that. So genomics is going to continue to be the driving force of drug therapy, and it has a great economic case to it. Drugs that are developed with genomics are about a third of the cost and developed in about a third of the time than the old approach of chemistry first. So this is causing drug companies to have amazing breakthroughs extremely quickly. The final areas of the portfolio as far as applications go are e-gaming and fintech. Fintech is one where we are selecting the companies that are most exposed to the technology changes that are coming in finance. You know, we've all obviously heard about cryptocurrencies recently, but that's only part of the story of the transformation that's happening in technology. Increasingly, it's all about digital money. It's all about online payments. I've not used cash in over a year. Obviously, part of that is due to the stay-at-home order. But in fact, even for the year before that, I was barely using cash. I've been tapping with my phone. That's how I make payments. And we've moved forward in the world in terms of how we think about money, how we think about our finances. And these companies that are focused on that area are the ones that are really gaining ground and competing with major banks. They tend to be in payments, but they also are increasingly going into other financial services. And I think we're probably going to see a big wave of consolidation as the banks decide that they need to look to own some of these technologies to make sure that they maintain their predominance in the economy. Finally, video gaming has become one of the biggest categories in the consumer economy in terms of entertainment. It really took off last year. The video game industry had a massive boost from the stay-at-home order. it didn't. It certainly helped e-gaming adoption that regular sports were canceled. You couldn't take your kids out to a ball game. But even that being said, the growth in this industry is eye-watering. The video game industry today has revenue about $160 billion, which puts it on par with the Canadian banking sector as a category. It's bigger than music, TV, and movies combined in terms of revenue. And the reason for that is that this is not the old video games of our childhood. This is an entire ecosystem of commerce that is happening online. Video games often are free to download, like for example, the hit game Fortnite, but you pay as you go, buying things for your gaming character inside the game. Advertisers are paying enormous amounts of money to video game companies to put their ads inside the game. You look at a company like EA Sports that does the sports games like hockey and basketball, for example. They have ads for real businesses on the virtual billboards inside the virtual stadiums where people are playing. And so the number of sources of revenue for e-gaming has taken off, and it has moved to a subscription model. So it's a completely different business than the old days where you would go to the video game store and you'd buy a video game disc and you'd come home and that would be your entire commercial interaction. These days, people are interacting in smaller ways with subscriptions and in-app purchases, and it has caused the category to absolutely balloon. And it's all a data-first theme. Because obviously all of this stuff is happening in the cloud and requires all the other components of data and data connectivity and cybersecurity that we've spoken about. So on the screen, you can see here some of the categories. This is a passive, I'm so sorry, I just got a phone call that disrupted my screen share there. I hope I'm still sharing. Can you see that?
Yes.
This is a passive index approach to our product. We built this index with our index provider Selective to address these themes. Every quarter, the portfolio rebalances equally across each theme. Some investors want to have just an individual theme. So you can see for 4 of them, we offer them as standalone ETFs. Cyber is available under the ticker CYBR, cloud computing under the ticker DATA, automotive innovation with the ticker CARS, and e-gaming on the ticker HERO. You can buy those separately, or if you don't want to kind of make a bet on any one of those categories and you want diversification, you can get them all in one solution. So this solution gives you 262 holdings. It is a market cap on average of $51 billion. So these are not small companies. We have rules in our index methodology that have a minimum market cap must be at least $100 million. And you have to have at least your $2 million of daily traded value in order to be included. And this is to make sure that we have an investable universe of big enough companies, but these companies are much larger than that. And on average, it's 51 billion. We have this available in a number of classes as well. We've got the regular class Edge, in which case in that class, we also hedge out any currency risk because this is a global portfolio, and we make sure that the currency risk is taken away so that you're not having any disruption to your return. If you want currency risk, you can have Edge.U, which is denominated in US dollars and is not hedged because it is predominantly a US dollar portfolio. Although it is global, there's a larger weighting of US dollars. So for Canadian or US investors, we've got both. We're also available in mutual fund classes. If you prefer to use Class F or Class A mutual funds, it's available in both of those. As I mentioned, the index rebalances every quarter. It is a medium to high risk rating, which is lower than a lot of tech ETFs, as a matter of fact, partly because of its large diversification. And all of this is available to your investors at a management fee of 40 basis points. So we see a lot of users adopting this fund as a way to invest in the future without having to pick particular winners and losers. It's something you can add as an allocation to your portfolio, give you diversification, re-engage the growth of your tech allocation into segments of the economy that are changing before our eyes that I think people are largely noticing and sometimes wondering how to get access to, and that's really why we built this product. So with that, I'm gonna end my slide share here, and happy to chat, take questions, or talk about anything anybody wants to dig into.
That was great, Elliot. Thank you so much. That was a really comprehensive overview of Edge. I really appreciate it. A couple questions I have, with the election of Joe Biden to the U.S. White House presidency, he's committed to building 500,000 electric vehicle charging stations as part of its $2 trillion clean energy initiative. How will this impact the portfolio, and how do you see it playing out in the future?
Yeah, that's a wonderful question, and I think it's very astutely goes to the heart of the way in which private developments in these technologies are also aligned with public needs and government mandates. You know, it's no secret that Joe Biden wants to make clean energy a key cornerstone of his presidency. And he's not alone. In fact, that just really means that the US is catching up to what we've seen in Europe for the past 10 years in terms of trying to get electric transportation to become a bigger part of the economy. So what does that mean to our fund? Well, obviously for the cars allocation, we're just going to see a massive shot in the arm to the automakers who are making electric vehicles, because, he's talked about an enormous number of new charging stations. And in fact, that's probably the biggest single thing that's holding back customers from buying electric cars is they're not sure, can I charge them up when I need to charge them up? So when you put those 50,000 charging stations in each state and you've got them out there in as widespread as gas stations, people are going to be looking at it going, well, I don't understand why I would want to pay to gas up my car when I can charge up my car at home most of the time. And if I'm on the road, I've got lots of places I can charge up. And so people will then change their kind of mental model of how they use their car. As far as the companies that are going to benefit from this, you've got the battery makers are massive beneficiaries of this because you're just going to see more adoption of battery vehicles. The same kinds of technology that go into batteries also go into charging points. So you're seeing a huge, in fact, we've seen it in the past few months. If you follow copper prices, they've just been skyrocketing as people are saying, like, this is the single biggest input of batteries and charging infrastructure. You need to buy copper. It's a great signal for this theme. The other thing that maybe is underappreciated is just how high tech these things are. You need semiconductors from companies like AMD that we have in our portfolio in both the car, in the charging technology within the car, as well as in the charging at the charging station, right? These devices talk to each other. You
Right.
plug in your car and the charging station says, how's it going? How warm is your battery? How much can I give you in terms of power? And the car reports that back, and all of that kind of technology happens. So we're going to see a real shot in the arm there as well. So we think this is we think it's about time, first of all. We think this is one of these things that's been talked about, and now we're going to really see it. I think that investors have noticed that. EV stocks in the past 6 months have really rallied since the election of Joe Biden, as people have started to say, we got to get into this space as investors.
Mm-hmm.
I think, again, as I said, the US story is great because it brings it into prominence in the news cycle, but it really just means the US is catching up with a lot of other places, and that's amazing because they needed to get there and they're going that way.
Yeah, no, that's insightful for sure. I would agree with you 100%. But further on, with respect to the pandemic, and you touched on this a little bit already, but what are the prospects for technology as we go through this process? So unfortunately for Canada, it seems like the tunnel's a bit longer than some other countries. But how do you see technology and the prospects for this sector post-pandemic?
Yeah, I think that we will talk about life pre-COVID and post-COVID, and we're not going back to everything we did pre-COVID. Like, as I mentioned, I'm not going to be going to the bank machine and getting cash just because I'm now going back downtown. Like that's over. I don't see that being part of my life because I've made the transition to digital spending. I think that's true also for many of the forces that the pandemic brought upon us. the best analysis I've read is that the pandemic didn't introduce new themes, it just accelerated themes that were already in place. It brought forward demand in the video game sector. But for example, the estimates I've read in terms of video game spending is that of all the new video gamers that have been added to the market in the past year, it's expected 3/4 of them will continue playing video games after we go back to normal. So you now have a shift. You have a whole new audience of people who are spending money online. They're used to it. It's where their friends are. I know my kids are on their video games, and that's how they socialize. They're not going to stop doing that. They're going to continue. They're going to go back to seeing each other in the park and doing other things because they desperately want to. But they're not going to, you know, you would have to tear my son's Microsoft Xbox and Microsoft subscription out of his cold hands to get it away from him. Now he views it as a human right to be able to play video games as often as he wants. He's like, that's where my friends are. So those things I think remain. And what I think is exciting is that there's a huge opportunity for investors here, because the pandemic has kind of called where they're going to hit the ball, where the economy is going, has now been signaled so strongly. And, you know, we'll go back to normal, but we're going to go back to normal having learned all these things. And, you know, it's just like we see a lot of companies saying, well, we're going to go to a hybrid model. People will work from home, sometimes work in the office. Other times after COVID, people will have more of that balance. The same is true for so many of the themes we see here. Digital finance is here to stay. Digital entertainment is not going to go back to what it was before. All of these transitions, and you know, thankfully we have got these innovations in our lives when this pandemic hit. We've really been very lucky to be in a country with as good public infrastructure as we have for things like the internet and the technology that we have, and to be able to do this today. I don't see stopping doing these kinds of partnerships with yourself just because we live in different cities. When we go back to work, we can continue doing this sort of thing. It's going to be great.
Yeah, no, good view on that too. With respect to the ETF, you mentioned earlier it's got you know, over 250 positions. Can you talk about how you thought about index construction and diversification when you're putting this together overall?
Yeah, absolutely. So when we started to put this together, we thought, okay, each category of the index needs to stand on its own as a portfolio strategy. We can't have any kind of weak link to this. So we've got 8 categories. We need to make sure each of these 8 categories is robust. It needs to be able to have rules in place for its category to make sure it's got truly representative of the leading companies in that category. When we design all of our indices, it's a bit of an art and a bit of a science to make sure we have the right signal to noise ratio. We can't have an index that says it's going to do something and then have something else show up. You know, if you had in the robotics category, if suddenly the index rule caused McDonald's to get in there, we'd say, well, why is that in there? That's not a robotics company. So you got to make sure that it's got what we said. Each category is built that way. The consolidated portfolio across all the categories and this product itself, we brought this to market because of conversations with investors who we were talking to about cyber and cars and data, our standalone ETFs. And they said, that's great, but I want something that covers all the bases because I want to invest for the long term. We agree with the thesis that data is changing the world. How do we get broad access to it? That's why we built this. And so it's a portfolio of portfolios. We're not trying to overthink the weightings. We're not trying to pick winners. You get great diversification when you hold edge, but you are very much accessing a theme of data first, transforming our lives. That is, I think, a good sweet spot. And then if you are using the product and you see a name in there that you really love and you get, you know, you really do a lot of research, like Intuitive Surgical, one of my favorite companies, maybe you end up buying a little bit of that into your portfolio beside the ETF because, you know, you're following that directly, but at least, you know, you've got your category exposure there. And that's why we built it that way. Okay.
Well, Elliot, once again, I really appreciate the time and the opportunity to speak with you about this. It's a very interesting investment opportunity, and I certainly believe that this conversation, you know, yielded some really insightful commentary with respect to the approach that you're taking to the sector, one that I think I agree with. So once again, thank you so much for a great presentation. And to all of our viewers, of course, at Dollar Wealth, we focus on helping you meet your goals and objectives, and we'd be happy to meet with you to discuss how this might fit into your portfolio and how we might serve you. So stay safe, everybody, and thank you very much, and have a good rest of your day. Bye-bye. Take care, Elliot.
Thanks, Romel.
Yeah, bye-bye.